Welcome to Financially Speaking. I'm Shaun Latter. Now, for many South Africans, the topic of retirement is approached with mixed responses and emotions. For some, they look forward to a time of relaxation and reaping the rewards of a successful career. For others, however, the outlook is perhaps not as desirable. One thing is certain though, the success of one's planning in the years and decades leading up to that moment have a significant impact on how one will potentially live their golden years. Now, joining me in the studio to take us through the ins and outs of pre-retirement planning are Raylan Dunbar, Financial Advisor at FinLogic, Andrew Davidson, Head of Institutional Asset Consulting at Axis, and Harry Joffe, Head of Legal Services, Discovery Life. Firstly, good evening, welcome, and thank you for taking the time out to speak with us. Before we jump into our discussion though, let's take a quick look at one of our viewers' questions for this week. It comes from James in Hartbeespoort. And James asks, how much of my monthly income should I be putting towards my retirement planning? Now, I'm sure this is a question on many people's minds, and one with mixed responses and certainly a lot of variables there. But Raylan, from your point of view, how would you approach this question?
Well, firstly, we would obviously have to speak to James and find out what age he is, how much retirement planning he already has in place, such as a pension or provident fund with his company, and he might also have an existing retirement plan or other forms of retirement planning already in place. If he's very young and he hasn't started saving at all, then obviously the amount that he needs to put away will be a lot less than what it would be if he's a lot older. Now, for example, somebody that is 20 years old and wants to retire at the age of 65 only really has to put away about 10% of their income in order to be able to get their actual replacement income in retirement. However, if he's now looking at the age of 40, for example, wanting to retire at the age of 65, those statistics jump up quite substantially, possibly to about 30% that he should be putting away in order to get to that same retirement age. So obviously it is quite important to really understand what that person's specific needs are, what kind of income they would want to be earning in retirement, and what their obvious needs are. But the other thing is also to look at a situation where people need to make sure that they are planning long enough for retirement. Unfortunately, a lot of people are living much longer than what they used to in the past. So what's happening is that people are retiring earlier and living longer in retirement. And this is a scary thing, that most people run out of money. So what's really important is that people need to sit down with a financial planner and really go through all the variables in detail. Take inflation into consideration, because that really eats away at your returns. And from there, be able to put a plan together for each person.
Now, surely, I mean, if we speak of the longevity, which is really a risk that's coming into the market right now, the sort of broad sort of factors that you gave out there of 10% upwards, does that take into account that longevity risk?
Yes, it does. The best thing really to do is, in terms of retirement planning, is to actually set it up in terms of preserving your capital. That way you're at least in a position that you don't run out of money after a certain period of time. Very often people look at their retirement plan and have a look at the lump sum that they've got available when they actually want to retire. And based on that retirement amount and how much income that they need, they generally take an income far higher than they should be taking in the beginning of retirement. And what happens is that if they don't put in escalations in terms of inflation and that type of thing, their money generally erodes quite quickly. Now, if we do it as a preservation of capital, obviously it's a bit more expensive in terms of actually preparing for it. But if you get to a point where you now outlive that period that's actually been planned for, you still have your capital intact, which you can now start earning income from.
Andrew, obviously we now know age is a big determinant. Surely one's investment strategy or philosophy that they adopt becomes an increasingly important thing to consider as well?
Yes, definitely. I think to tie back to the level of contributions, actually your investment strategy needs to take into account what level of contributions you're paying into your retirement fund or your retirement annuity. And it needs to obviously adjust according to whether you're on track or how much you have in relation to where you should be at any point in time. So for example, if you are only contributing 10, 11, 12% and you're in your 40s with very little accumulated capital, you may need to target a higher level of return from your investment strategy. Whereas if you've been quite disciplined and saved a lot from early on in your working career, you may have the luxury to actually target a lower return and hence have a less risky strategy.
you brought up a risky strategy, and this is something that comes up time and time again. And when we have a look at a risk of a certain investment, we're normally talking about the market risk, and more importantly, perhaps the volatility of it. And we often measure it in annual returns. But now most people are sitting where they could be in an investment strategy for 40, 50, 60, or even 70 years from the day they start through to the day that they die. How is it that you see people are responding to this? Because a lot of people think that their retirement savings should be a lot more conservative, yet they could be a disadvantage to themselves. Do you think over-conservatism is something that's a problem?
Yes, definitely. And I think it's partly the problem that there's so much more legislation, there's so much more focus on advice and getting the right investment strategy for a client or for an individual, that it tends to lead people to be a lot more conservative than they would otherwise be. And I think this is damaging for individuals. For example, you've got a situation where a youngster who has a long time horizon, as you say, 40 years, 35 years perhaps, there's no reason for them not to have a high percentage of their assets in growth assets like equities and property. And yet a lot of individuals, because of their concerns about the future or their concerns about the stock market, or advice even from an advisor who perhaps has taken too short a term view, they might end up in a very conservative strategy that is going to be damaging because of the fact that they actually need growth above inflation and substantially above inflation.
So it's really about balancing the market risk and the potential inflation as well as longevity risk through having a perhaps more aggressive strategy in your retirement plan.
Yeah.
Harry, let's just chat very briefly about some of the different products or vehicles that are available for retirement funding in the pre-retirement phase.
Okay, let me just say up front, I've just gone past 40, so I'm getting a little bit nervous, Roland. I'm not sure if I should be at the 30 or the 50. But obviously we're going to look at different insurance products. You know, we've got different wrappers basically. An RA, which is a wrapper, a unit trust, which is a wrapper, an endowment policy is a wrapper. And you know, there it depends on the tax profiles. Roland was saying we look at their age profile and what they're currently investing. With the wrappers, we look purely at the tax profile. How much rebates have they got? What's their marginal rate of tax? What's their income position? And then we can start putting them into different wrappers, with each one having their own tax advantages and disadvantages. So that's a very much an open-ended question. We need more specific facts, and we've got a bit of time later on. I can show you how each wrapper is appropriate for a different tax profile.
For a different tax profile. Obviously the question of liquidity has to come in there somewhere as well?
Correct to a point, but if we're talking long-term, as Andrew and Roland were talking, then liquidity shouldn't be that much of an issue for retirement planning.
Okay. And in terms of maximizing your tax efficiency from a contribution point of view, because now someone's in the environment saying, well, I need to start saving perhaps more than what I've already done, and maybe it sits outside of what my maximum tax deductibility is. Just a few moments in terms of a max deductibility from retirement annuity, and then what to do if I exceed that.
Right, well, I mean, in terms of the law, and I don't think I should get too technical yet,
Sure.
15% of your taxable non-retirement funding income can be contributed to an RA and claimed as a tax deduction. If you go above that, it probably doesn't make much sense to carry on going into the RA, because you'll then be locked into age 55, and then we start looking at endowment policies or unit trusts. But again, it's not as simple as that, because some people on purpose put more into the RA because they want to use it, for example, on estate duty shelter or something like that, even though it's not tax deductible. So, you know, there's a rule of thumb that you only put 15% in, but that rule of thumb doesn't always work. It's very much dependent on the facts.
And then, of course, the question of discipline will also come into it. Being those endowment, LISP wrappers, whatever the case may be, can be quite easily accessible.
Correct.
From that point of view. Andrew, I mean, you work very closely in the pension provident sort of environment. In terms of contribution rates, what is it that you're seeing as a general trend?
Well, I think most schemes tend to have a set contribution level. So in other words, they don't give the members a choice in terms of what percentage of their salary they can make. But there are increasing numbers of funds that are actually saying, let's give the members a choice in terms of the level of contribution as a percentage of their salary. Now this can be a good thing, but of course it can also be a bad thing, depending on how low those contributions start and how apathetic members are about the future. So for example, if you've got a scheme that starts at only 4% of salary, then we're clearly not going to be on track for any sort of meaningful replacement ratio, which is the pension as a percentage of their salary just before retirement. So they're not going to be able to maintain their standard of living in retirement. But in general, I would say most members are contributing somewhere between 10 and 14%.
between 10
of
and
their
14%.
salary, yes.
So depending how early they're starting, they may or may not be in a position. Now, the unfortunate reality, as we know, is that some people set out on the right foot, but then when they move jobs, often preservation becomes a problem. And again, this is something that could put your retirement planning in jeopardy. The trend, people cashing in their sort of pension provident funds, what are the implications, both short-term and long-term?
Huge. Short-term, obviously, there's tax implications because any money that you're receiving from a pension or provident fund, you're going to be taxed on. Now, very often people look at the amounts of money that they've saved up, and chances are that they're in a position where they might want to start their own business, they might have been retrenched, they might be in a position where they're just looking to move into a better position, get more income, but the problem is the new job that they're going into doesn't necessarily have pension or provident funds in place for the employees. So the concern really is that people start off generally on a good foot if they're with a company and there are benefits already in place. But obviously going forward, it needs to be set up the whole time and increase continuously based on tax deductibility, based on the fact that obviously you need to be contributing as much as possible. You know, the scary numbers really are is that if people, for the amount of years that people actually work, they could actually be in retirement for that same amount of years. So if you think about what you're putting away, if you're only putting 10% away of your income each month, even with good growth through the markets, you're still in a position where you're possibly going to run out of money in retirement and you're not going to be able to replace your income correctly.
So it's all about making the informed decisions. I'm certainly not one to say you should or you should not do X, Y, and Z, but certainly I think a lot of people don't understand the implications of cashing in those policies.
You know, cashing it in also, you're losing out on the value of compound interest. I mean, your compound interest can be a small amount in the beginning, but compounded over a 20, 30, 40-year period, it really starts to grow quite substantially. So my suggestion to people, whenever they're leaving their company, is always use a preservation plan. You don't pay tax on that money because you're transferring it into a plan which then continues for you, and ideally it's in your own name at that point. Now you're also not in a position where you have to be subject to whatever the fund does in terms of your investment portfolios. That's, from my point of view as well, is another concern. A lot of times, you know, the trustees of pension or provident funds generally try and go a more conservative route. And as Andrew's already alluded to, we're in a position where young people can't really take the risk of being too conservative because their money doesn't outperform inflation correctly, and long term they obviously don't make the returns. So very often from a fund point of view, people are quite limited in terms of their portfolios. But I think the trend is starting to move to where people can have their own funds and where they are starting to have riskier funds available for the younger people. And people really need to consider looking at that.
And they can start making decisions from there for their own unique set of circumstances.